Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Today I'm going to be chatting about NCUA's stablecoin proposal and what credit unions need to know in that regard. Now, the NCUA has issued a proposed rule to implement the Genius Act, which was signed into law on July 18th of 2025. That act requires that NCUA and other regulators establish a licensing framework for credit union subsidiaries that want to issue payment stablecoins. Here's one of the big takeaways. Credit unions cannot issue stablecoins directly. They must do so through a licensed subsidiary. And when you hear subsidiary, what do you think of? Of course, credit union service organizations or QSOs. So that's likely where this will land if it makes sense for you and your credit unions, your credit union members, and the industry. So this proposal sets the groundwork for how that would work, and it raises some important strategic and regulatory questions that I'm going to break down here. So as a refresher, what is the Genius Act? The Genius Act creates a federal regulatory structure for payment stablecoins. Under the Act, only permitted payment stablecoin issuers, or PPSIs, we'll see if that acronym takes off, can issue payment stablecoins in the United States. Insured depository institutions, including credit unions, cannot issue these directly. They must operate through subsidiaries. Those subsidiaries are supervised by their primary federal regulator, and of course, that would be NCUA in federally insured credit unions instances. The Act also requires one-to-one reserve backing using U.S. currency or other approved liquid assets, public redemption policies, monthly reserve disclosures, AML and BSA and sanctions compliance, IT and risk management standards, and critically, stablecoins are not federally insured. They are not backed by the full faith and credit of the United States, and they cannot be marketed as such. Now, NCUA must also issue implementing regulations by July 18th of 2026. It'll be interesting to see when that comes out. It'll be interesting to see if when that comes out, Kyle Hauptman's still on the board, or we have a new board chair, or who knows, Hauptman and Oatsko win or lose their lawsuit. There could be different board members proposing that required rule, so to speak. Now, this proposal is only phase one, licensing and investment structure. A second proposal will cover operational standards. So we've got this proposal. We have another proposal, which will be operational standards. And then they would have the implementing regulations that will follow. So the Office of General Counsel, which has lost a big chunk of their staff because of the reorganization, is going to be quite busy on proposing these regulations, which may or may not have any bandwidth in the credit union industry. Well, time will tell. So how is this similar to the banking regulators? Is the NCUA proposal materially different from the banking regulators are doing? The short answer is no, not really. Structurally, they're almost identical, and that's because they're all implementing the same law, the Genius Act. The statute directs the NCUA, the FDIC, the OCC, and the Federal Reserve to build a licensing framework for PPSIs. Now, across regulators, you see the same architecture. Stablecoins must be issued through a subsidiary, a licensed subsidiary. Applications are reviewed under the same statutory factors. Regulators have 120 days to act once an application is substantially complete. Now, that's interesting in that it puts the onus on the regulators that if you're late, you're going to get approved. So if they missed 120 day, but what that also means is substantially complete. What you'll see in field membership cases historically or other actions is they'll say your application is incomplete. You need to address ABC, and that restarts the clock. So watch for that 1, 2, 3 years down the road once this thing is actually up and running. Issuers must maintain one-to-one reserves. There are strict governance, capital liquidity, AML, and technology expectations. And as I said previously, stablecoins cannot be marketed as federally insured. Where they differ is not in substance, but in institutional structure. Banking regulators generally assume a single parent bank model, and NCUA proposal anticipates widely held joint-owned cooperative subsidiaries, i.e. QSOs. That reflects the credit union model. So substantively similar, structurally tailored. A quick note on the Clarity Act and the rewards versus interest question. There's another bill floating around, the proposed Clarity Act, and some have asked whether that changes the stablecoin landscape. So here's my take. It does not replace the Genius Act. The Genius Act governs how stablecoins are issued and supervised. Clarity is broader. It addresses how digital assets are classified and whether they fall under the SEC or the CFTC jurisdiction. Now, here's the subtle issue. Genius is designed to keep payment stablecoins from looking like interest-bearing deposits or securities. If an issuer pays something that walks and talks like yield, even if it's labeled rewards, regulators will look carefully at whether it's economically the same as paying interest. That becomes a safety and soundness issue under Genius and potentially a classification issue under Clarity if the product starts to resemble an investment contract. For credit unions especially, this matters. Stablecoins are not insured shares. They cannot blur that line. So while Clarity affects the broader digital asset market structure, the interest versus reward debate will likely play out inside the Genius supervisory framework. And as an aside, there's a lot of podcasts. The FinTech Takes podcast talks a lot about this rewards versus interest. And in the FinTech Takes discussions, it seems pretty clear that this was a loophole, that the people got into the law that were supportive of crypto, that were supportive of stablecoin, and that, quite frankly, I think the banks and credit union lobbyists missed, because there is a workaround that allows it to be rewards. It just can't come directly from the stablecoin. And I think the Clarity Act has come along saying, oops, we should have done better on this. And it's creating, as structured, potentially more competition for banks than banks thought it would when they saw that originally they were not allowed to pay interest. But this reward loophole seems to be potentially problematic in that regard. So it'll be interesting to see where that plays out. So if credit unions want to participate in issuing stablecoins, it must, as I said, must do through a subsidiary. So that would be a QSO, and that subsidiary must obtain an NCUA PPSI license. So here's the nuance. Instead of requiring every investing credit union to apply individually, the subsidiary applies jointly with only what the rule calls parent companies, who qualifies as a parent company. Any credit union that owns 10% or more of voting securities or has the ability to direct management or policies. If no credit union owns 10%, the largest shareholder becomes the parent company. NCUA selected the 10% because it's a common material control threshold in banking laws. This avoids forcing dozens of investing credit unions to file duplicative applications, especially giving the 120-day statutory decision clock. The framework clearly anticipates pooled cooperative models like QSOs. Now, then there's the investment limitation and QSO implications. As a reminder, for federal credit unions, the constraint is the 1% cap. Federal credit unions may invest up to 1% of total paid-in unimpaired capital and surplus into organizations such as QSOs. PPSI investments aggregate into the same 1% bucket. So if your institution is already near its QSO limits, participations may be a bit constrained. The NCUA is also proposing that PPSIs formed by federal credit unions operate through, of course, the Part 712 QSO framework. That raises legitimate questions. Should PPSIs be treated differently from traditional QSOs? Should certain Part 712 requirements be streamlined or made tougher? Should PPSIs be required to register in the QSO registry? The board, the NCUA board of one, is openly requesting comments on these issues. Now, in regards to licensing requirements and evaluation factors, applications, it's proposed, will be evaluated under statutory factors, including financial condition and reserve sufficiency, absence of disqualifying felony convictions, competence, experience, and integrity of management, adequacy of redemption policies, and overall safety and soundness. As proposed, applicants must submit detailed business plans, pro forma financial statements, capital and liquidity plans, technology and risk management documentation, biographical and financial reports, fingerprints for certain officers and directors. Once an application is deemed substantially complete, NCUA has 120 days to decide, as I mentioned before. If the agency fails to act within that time frame, the application is deemed approved. That's not a situation any regional director ever wants to find themselves in, where they approve something by not responding. So this statutory clock is important, and it does matter. So the cost question, NCUA is also considering how to fund this expanded supervisory role. Options include licensing fees, examination fees, or spreading the cost across all credit unions through the general budget. My guess is a lot of credit unions won't like that last option, unless, of course, they want to be in stablecoins. They'd rather have it spread out. If you're not in it, you probably want to have the individuals that are in it to pay for it. Because stablecoin participation is optional and likely limited to a minority of institutions, the board is obviously seeking whether costs should be borne only by those participants. That discussion could become a significant part of the debate. So in closing on this topic, what does this mean? First, this rule does not push credit unions into stablecoins. It creates a potential pathway. Second, the framework is cooperatively friendly. Third, capital constraints and structural limits matter. Fourth, operational standards are still coming, so stay tuned for that. I guess it would be pretty soon. This is one of the most significant expansions of NCUA's supervisory authority in recent memory, some would pose. It places the agency firmly into digital asset regulation, but in a cautious, safety-focused way. Comments are due 60 days after Federal Register publication, so roughly in 60 days from now. If your credit union is even considering this space, now's the time to engage if the proposal makes sense. NCUA does listen to comments, so I encourage you to take a look at that. Now, pivoting away from that proposal, NCUA also recently announced stage 5 of their round of deregulation proposals. The short version on this is that this is mostly changes from happy to glad or glad to happy. What does that mean? It means these are mundane tweaks to regulations, and the items that were in version 5 of this relates to 3 proposals: conversion of insured credit unions to mutual savings banks. The board proposes to reduce regulatory burden and increase flexibility by eliminating some procedural, disclosure, and communication requirements for converting insured credit unions to mutual savings banks. That happens very rarely. I can't remember the last time that happened. It was big about 15 years ago, but they're making it less onerous should a credit union want to take this direction. Impact on credit unions, among other things, the proposed changes would simplify regulatory compliance for conversion disclosures and allow credit unions the flexibility to design disclosures that are effective and clear for their members. The next proposal that has a tweak to it is the mergers of insured credit unions into other credit unions, voluntary termination or conversion of insured status. The board proposes to retain the core disclosure and notification requirements when a credit union's members vote on a decision to merge or terminate federal insurance coverage and convert to private insurance, but eliminate prescriptive requirements associated with those disclosures. What's the impact on credit unions? This proposed change would relax and dictate to provide modest merger-related cost savings and reduce unnecessary burden. It would provide credit unions with greater flexibility in designing effective communications while still ensuring that members receive clear and prominent notice of a proposed termination of federal insurance. Why any credit union would want to go to private insurance, I have no idea. And so it's rare. This is even rarer than the mutual savings bank one discussed earlier. So again, this is a deregulatory change that really impacts virtually nobody, or as Van Morrison once said, what's the sound of one hand clapping? Lastly, the organization and operation of federal credit unions. The board proposes to rescind IRPS 06-1 because the current field of membership FOM requirements are in the chartering manual. So what's the impact? This change would eliminate a redundant standard currently listed in more than one area. This would ease the compliance burden on federal credit unions by limiting the number of sources they must check to ensure compliance with applicable community chartering and field membership requirements. So again, not much there. The big takeaway is what we talked about for most of this podcast, which is the stablecoin proposal, which was required to be put out. NCUA is going in the direction that they're required by the law, by the Trump administration, and it will be interesting to see where this heads. It'll be more interesting to see if stablecoins actually do ever take off and do impact banks and credit unions. A lot of noise around this, a lot of theories around it. And, you got to play to win sometimes. I'm not sure if this is something that will ultimately be important for credit unions or not. What's your take on it? Send me a note if you believe stablecoins are the future or are not the future. All right, this is Mark Tricola. We've got some more exciting episodes coming up. I want to thank you for listening. Thank you for watching. As always, Mark Tricola signing off with flying colors.